So I guess we might as well kick it off if that's good. So welcome to the
Sure.
Financial and Legal Checkup for medical practitioners. I'm David Wickenberg from KWB, and with me today are Mark Yu from Field Law and also Britt Tess from Field Law. So here's what you can expect. We'll cover today a brief introduction about the two firms that are putting this on. Then Mark and Britt will talk about a few legal considerations, including some of the things you were just mentioning about contracts and structure and other things like that. And then I'll get into some financial aspects of running a practice and what you should be considering. And then we'll leave some time at the end for Q&A if you have any questions. But also during, feel free to interrupt and ask if something comes to mind. So KWB, we started the firm 25 years ago. We're very much cloud-based. We do a lot of work in the cloud, especially in the last 4 or 5 years, so we can serve you wherever you are. We've also, in the last couple of years, really enhanced our advisory services. We were often available to do that work, but not necessarily promoting what we could do. And so we were waiting for people to ask us, and now we've realized, you know what, it's way more valuable, important to offer that and provide information as to what that is to help improve your business. In addition, we do the basic financial statements and tax returns. We started to do bookkeeping about 4 or 5 years ago with the cloud assets and resources that were available, and all sorts of other various things. Most of it kind of under the umbrella of the advisory, but most of the things that you'd want to come and expect from a full-service accounting firm. And just to let you know, our mission, we really live by our mission and vision and values. We talk about a lot within the firm, and it helps guide us a lot. And really, we're here to provide great advice to you so that you can improve your business, simplify your accounting, because we know how much people do not like accounting. So help simplify your accounting so you can focus on what's important so that you can reach your goals. And that's really why we're here every day and what everybody within the firm is striving for.
Thanks, David.
Yeah.
Field Law, we have over 100 lawyers in 3 offices across Alberta and the Northwest Territories. And we're a full service law firm. So we enjoy working with clients, from the incorporation, the inception of their business, all the way through their business life cycle to, the eventual sale of the business. And throughout the way, providing guidance and expertise on how to manage risks, whether it's negotiating leases, bringing on employees or associates, dealing with privacy or other regulatory matters, and litigation as well. So our focus is really on customer service and helping guide you through the various stages of your business. So the first thing I'm going to address is the different corporate structures for your business. So there's sole practitioner, also called sole proprietorship, where you are running the business in your personal capacity as opposed to through a corporation. And the biggest difference between a sole practitioner and a professional corporation is liability. So as medical practitioners, you cannot contract out of or shield yourself from liability that arises from providing professional services. Whether you do that as a sole practitioner or through a professional corporation, you will have that liability arising from providing professional services. But in addition to that potential liability, there's also liabilities and obligations that come with running your business. So for example, you may be entering into leases, you might be obtaining financing to acquire a practice or to acquire medical equipment. You might be hiring employees and associates, and all the liability arising from those things outside of providing professional services. If you're a sole practitioner, you are incurring that liability yourself, and all of your personal assets would be available to satisfy any judgment in the event there was liability in those areas. Whereas through a professional corporation, you are not personally liable for those types of liabilities. So there's a liability advantage to practicing through a professional corporation, in addition to some tax advantages that David will discuss. It's also possible to practice in partnerships. They're not as common because at law, partners are vicariously liable for the obligations and liabilities of their partners. So we generally don't see them, but we can definitely advise on them. So I'll spend the most time on professional corporations because they're the most common. So with a professional corporation, all of the voting shares of the PC have to be held by the regulated member, being the medical practitioner. And then the non-voting shares of the PC can be held by the spouse or the children of the regulated member, or a trust, if the beneficiaries of that trust are limited to the regulated member, their spouse, and any minor children. And as I mentioned, with a professional corporation, you remain liable for any liabilities arising from the provision of your professional services, but there would be no personal liability for other liabilities such as lease obligations or financing, unless you had personally guaranteed those liabilities. So it's very common that because of the liability protection, medical practitioners will choose to carry on business through a professional corporation as opposed to in their personal capacity. And there's also a purpose for other entities within your corporate structure. So for example, you might have a holding company that holds the real estate, like being the building and premises that you carry on business through, or is the entity that contracts to lease premises and to employ employees or associates. And the purpose of having those other entities, those other holding companies in your corporate structure is that, first of all, if you want to bring anyone else into the ownership of your business, it's easier to do that if your business is being run through another corporation besides your PC. While you can bring another regulated member into ownership of your PC, because the voting shareholders, the regulated members, are liable for any liability arising from your professional practice, there's liability concerns with bringing in another medical practitioner into your PC, and it's better to do that at a holding company level. And then also, in the event of sale of your business, it's a lot cleaner, and there's some tax advantages if you've kept, for example, real estate, like the building that you own and operate out of, if you've kept that separate from your professional corporation. And there's also some additional liability advantages to having holding companies. So for example, if you own your building in a separate company and there's liability arising from that, or if you are leasing medical equipment or financing medical equipment through a separate corporation, if there's liability arising from that, it's only going to affect the assets of that holding company and not all the assets that you might have accumulated in your professional corporation. All right. So when professionals are looking to acquire practices and carry on business, often they're obtaining debt financing to purchase a practice or to purchase medical equipment. And so we deal a lot with bank financing for medical professionals. When medical equipment is being financed, the bank needs to secure the loan against something, and so the medical equipment is often the collateral that's given to the bank. But with term loans, for example, that are used to acquire a practice or operating lines of credit, when banks are looking to have security for those loans, the issue with medical practices that's unique to medical practices is, if the loan is not paid off and the bank needs to step in and appoint a receiver of those practices, without the medical professional, those practices are not worth much to the bank. They can't run those practices and operate and generate revenue to repay the bank loan. So for this reason, because of the difficulty in enforcing security against medical practices, banks will often require personal guarantees and also life insurance on the life of the medical practitioner that will then be assigned to the bank. All right. When you're looking to grow your practice and add other medical practitioners or employees, there's two different classifications. So you can bring people in as employees, or you can bring them in as associates, often called independent contractors. And the distinction between employee and independent contractors is very important for a number of reasons. Liability is one of them. So employers are vicariously liable for the conduct of their employees, whereas they're not liable for the conduct of independent contractors. With employees, employers have to abide by the employment legislation, including paying severance and remitting CPP and income tax deductions to CRA. Whereas with independent contractors, the obligations are set out in the actual contract with that independent contractor. And with employees, one issue we often see is severance. Now, if you have an employment agreement that limits severance to what is required under the Employment Standards Code, that will be upheld. But if there is no written employment agreement, or if the written employment agreement doesn't specifically limit or set out what severance will be, the employee is entitled to severance at common law, and that is the amount that courts have decided in similar cases that employees are entitled to. And the difference between severance under the Employment Standards Code and severance at common law can be quite significant. It can be a matter of months, 8 to 10 to 12 months more at common law than under the Employment Standards Code. So it is important to have written employment agreements with your employees. And then whether it's an employee or an independent contractor, having a written agreement is important to protect your interests. So, for example, in those agreements, you can have confidentiality provisions and non-solicitation provisions so that in the event your employee or the independent contractor ceases to be employed by you, they're prevented from soliciting your clients for a period of time or from taking confidential information from your practice and using that to potentially compete against you. As well, in the agreement, it can address ownership of any intellectual property rights that either the employee or the independent contractor might create as a result of working in your practice. Medical practitioners with their own practices often don't own the real estate that they're operating out of. Often it's leased. And so here's some high level things to watch out for when you're negotiating leases with landlords. The first is the amount of the tenant improvement allowance that will be given to you to help build out the space for your needs. And the period of time called the fixturing period that you're able to build out that space for your needs without paying base rent or additional rent, usually only paying utilities. Depending on the market, landlords may require personal guarantees. Right now, we're in a market that's very good for tenants, so lots of tenants are able to negotiate leases without any personal guarantees, but as that market changes, landlords may be requiring personal guarantees, and if they do, you can negotiate to have, first of all, the personal guarantee be limited. So instead of you being personally liable for all obligations under the lease, you can limit it just to, for example, base rent. And you can also limit it by having a declining balance over a number of years during the term. So each year, the amount that you're personally liable for will decrease. Because you are investing time to build out your space, and this is where your practice operates, it's important that you have sufficient renewal rights that will allow you to continue to stay in that premises, after the expiration of the initial term. And then if you're thinking about growing your practice in the future, another provision to negotiate is the option to have a right of first refusal to lease contiguous space in that premises. So if the bay next door is up for lease, you have the first right to lease those premises to expand your business.
You froze there for a second, Britt. Maybe just repeat that.
I think relocation.
Uh-oh. You froze again.
I think she's getting through a bit of that stretch of Wi-Fi here.
Oh, that's unfortunate.
Well, I think she'll free up, and the next slide starts with me. So maybe we'll move back to Britt once her video starts working well again.
Sure.
Okay, great. Well, good afternoon, everyone. My name is Mark Yu. I'm one of the partners here at Field Law. I primarily practice and Britt's back. Britt, did you want to finish off your comments from the last slide, or have we abandoned and gone on without you here?
I just had just 1 minute to go through clauses to watch out for leases, so I'll continue. All right, so relocation clauses. Some leases will have a provision that says at the landlord's option, they can relocate you from your current bay to another bay within the shopping center, and they want this option in case they have another tenant who wants to lease more space where you are. And that would be very disruptive to your practice to have to relocate. So those are clauses that we like to negotiate out. Also, landlord termination rights. So some leases will contain rights of the landlord to terminate your lease if they want to, demolish the shopping center. And then damage and destruction clauses. So most leases will contain a provision that says if your premises or the shopping center it's located in are damaged, as long as they can be rebuilt within X number of months, you do not have the right to terminate your lease. You have to continue with your lease. You're entitled to an abatement of rent, but you have to continue with your lease. And then once the premises are rebuilt, move back in. And depending on how long that period is, you might want to be able to terminate your lease to be able to go find space elsewhere so you can continue to carry on your practice. So there's definitely a lot of negotiation back and forth on damage and destruction clauses. Same with changes to common property. So if you're in a location where visibility is important to you and you don't want the landlord to construct an additional building, in front of you in a way that impedes visibility of your building, it's important to negotiate that into the lease that the landlord doesn't have unfettered rights to deal with the common property being the parking lot in front of your building. And there's some other ones that we usually negotiate, but those are the big ones. So thanks for bearing with me during those technical difficulties, and I'll hand things over to Mark.
Just a quick question, Britt. Cassie posted a question: what kind of clause would be necessary to exit lease if you can't continue to operate your practice, say, due to the pandemic?
That's a great question. So under the lease, you're obligated to continue leasing the property for the term of the lease, whether it's 5 or 10 years. And the only way that you'd be able to exit your lease is if you negotiated what's called an early termination right. And that's a right that allows you to terminate the lease prior to the expiration of the term by giving the landlord, say, 6 months notice.
Great, thank you. And is there any other questions for Britt before we move on to Mark? Just while it's still fresh, either on negotiating leases or agreements with employees or contractors, or the structure that she talked about? Okay, sounds good. Well, we should still have some time at the end if you do think of something. So Mark, take it away.
Great, thanks a lot, David. As I've been indicating earlier, I am a partner here at Field Law in the Edmonton offices. I'm a litigator at heart, so I mainly do malpractice defense work for healthcare professionals, nurses, physicians in some contexts, and basically every other profession that you might be able to think of. The other part of my practice is privacy and data management. And that's what I'm going to do. That's what I'm going to speak to for the next few minutes here. I could probably talk about it for an hour and more, but we don't want to squeeze out David's contents from this presentation and hijack it with legal content rather than his information. So data and privacy and data management is probably one of those areas that actually affects your day-to-day practice on a regular basis, but it's something that we don't necessarily turn our minds to. So in Alberta, we have a specific piece of legislation, the Health Information Act, that governs the collection, use, and disclosure of health information. And this applies to all custodians that are defined under the Act. So this usually includes hospitals, healthcare, other healthcare clinics, authorities, but it also defines specific regulated healthcare professionals that are parts of the definition of custodian. And this would include physicians, optometrists, registered nurses. So it's a pretty long list. So even if you don't work in a healthcare facility, you as a regulated profession that falls under the definition of custodian needs to be aware of the contents of the Act and abide by the legislation. It also applies to affiliates of custodians. So if you're employing other individuals, even including individuals that you are entering into contracts with, volunteers, if they're working for you or if they're volunteering with you, they also need to abide by the legislation as well. And you're ultimately responsible for that as the custodian. Healthcare information is defined pretty broadly under the legislation. So this includes what you would typically think of as health information, including diagnostic, that's treatment, not treatment, so that's my typo, care, registration information as well. So if you are taking insurance information or if you're taking billing information for a client while you're providing them with health services, then that's something that falls under the definition as well. And the Health Information Act creates a general obligation for you to maintain that information using reasonable safeguards. This includes physical, administrative, and technological safeguards. There are specific sections under the Act that require you to be specifically cognizant of electronic health information as well. So you have to specifically turn your mind into the risks that that type of information might pose for your organization. There's also a number of other obligations that are placed on custodians under the HIA. You're responsible for creating privacy policies and procedures. If you're entering into a relationship with an information manager, so an example would be an electronic medical records provider, if you're getting someone to maintain your records, to store your records, then there are specific provisions that you are required to have in your agreement or contract with them. If you're altering or introducing a new way of handling information or changing your information systems in a significant way, then you are required to create a privacy impact assessment, and I'll talk a bit more about that in a second. Additionally, if you have experienced a breach, whether that be unauthorized access, a loss, or you simply misplaced health information, so you hear about those situations where someone's driving home from work, you're going to a Safeway or whatever, and you have a laptop that's stolen from your vehicle, then you are required to provide mandatory breach notification. In terms of privacy impact assessments, like I said, they are required when your health information systems are changed within your practice, or you're introducing, for example, a new electronic medical records system. You are required to create a privacy impact assessment, also known as a PIA, which basically is a document that outlines how the information flows within your office or your work, how this information is going to be disclosed, used, accessed by other people, and what safeguards you might have in place to protect that information. This PIA gets submitted to a regulator in Alberta, the Privacy Commissioner. They review that PIA and they simply accept it. So they're not necessarily approving it and giving, blessing it with their authority in terms of what's in it, but it's a regulatory requirement that you must complete when you're implementing this new system. You are able to actually implement the system before you hear back from the Privacy Commissioner's office, because it often takes almost a year or more for them to get back to you, which, you know, I appreciate. If the purpose is to mitigate risk, then you would hope to have that information back before you actually implement any changes. But unfortunately, sometimes the timelines don't work that way. But the website for the Privacy Commissioner does have a list of different PIAs that they've accepted. So if you're thinking of introducing a new system, a new program within Alberta, then you can look at that list and see if it's been approved previously, and it might give you a good indication as to whether someone else is using it and whether the Privacy Commissioner has seen that system being used in the past. In terms of breach notification, again, also a requirement. Whenever you suffer from any breach that creates a risk of harm to an individual, then you must give notification to the Privacy Commissioner, the Minister of Health. It's a standard reporting process, and also the affected individual pursuant to the legislation. Always much better to mitigate your risks by providing that early notification rather than trying to hope that it goes away and is undiscovered. In terms of risks of non-compliance, I think as a professional, a healthcare professional, one of the main concerns is really reputation for your practice. But in terms of other risks to your organization, people can make complaints to the Privacy Commissioner, and we often help public bodies, custodians, and other private organizations respond to those complaints. Depending on the circumstances of the non-compliance, someone may make a complaint to you, to your regulatory college, against you to your regulatory college. What we are seeing in Alberta is the emergence of civil claims for privacy-related issues. So this is relates to things like intrusion upon seclusion. Those are your typical snooping cases. So say Connor McDavid comes into the U of A hospital, you work there, you're curious as to whether our season's dead or not, so you go into his health information to see what the injury is or what he's there for. And you might not be doing anything wrong with that information, you might not be misusing it, but that intrusion itself has been recognized as a means of civil liability. Public disclosure of private facts. So if you are disclosing private facts to the public, if you've obtained that information in your work and you're disclosing it when you don't have authority to, also another potential cause of action. Certain legislation includes a statutory provision where it says that if you violate this statute, then someone has an automatic civil cause of action. Not so much applicable in this instance, but that is possible. And again, reputational risk is the big one. And finally, things that you could do to potentially mitigate risks. We do offer services like privacy audits, where we look at your contracts, we look at your administrative processes to see if there's anything that you can work on. Part of that includes a review of your policies and procedures. Bringing back to what Britt had been talking about in her segments, those employments and contractor agreements are important in terms of specifically indicating that whoever you're working with is obligated to maintain confidentiality over the information that they might come across. during the scope of their employments. One thing to consider is cyber liability insurance. So if your organization is experiences a ransomware attack, for example, that you have the necessary support to respond to that breach from an IT perspective, a legal perspective, an ability to respond to any regulatory requirements that you might need to respond to, as we had just talked about. And really continuing education of your staff and volunteers. Again, you're all busy with your own practices. You have a lot of things that you need to take care of in terms of clinical care. But that continuing education component is something that's important and something that the courts look to when they're assessing whether a organization or whether a custodian has fulfilled their duties in maintaining health information and personal information. So that's everything in a nutshell. I know it's kind of just a 5 to 10 minute look at your privacy and data management obligations, but I'm happy to chat at the end of the presentation, or if you want to message or call me directly for something offline, then I'd be happy to speak with you. Thanks a lot, David.
Thanks, Mark. Any questions that come up for Mark that you can think of right now? Okay, no problem. There will, like I say, there will be time at the end to ask questions if something comes up. So, so we'll shift gears a little bit, get into sort of the financial and accounting space. I'm going to talk on two main areas. The first is sort of operational, and I'm going to talk about ways to hopefully kind of keep it simple and save time in your business. And then we're going to dive into sort of more the accounting and tax side, where we'll look at some basic of tax planning, tax issues, things like that, that you should be considering. And hopefully, if you're with an accountant, that they're doing these things, and or if you haven't started with an accountant, you should be considering and discussing. So. So as far as keeping it simple and saving time, again, that's, as I mentioned earlier, that's our mission. We're trying to keep you out of the accounting and finance as best we can, because you probably don't like it much, and we're trying to have you have the time to focus on your business. So I kind of think back to 10 years ago, even 15 years ago, I was doing all my banking, physically at the bank. And then we started to get, online banking and mobile banking, and now I rarely go into the bank. I'm doing all my deposits on my phone. I'm doing transfers on my phone or my computer. Well, cloud-based apps are similar. We highly recommend QBO, and QBO is a wonderful platform. That's QuickBooks Online for not just the actual accounting platform, but there's hundreds of apps actually that tie into it. But the 3 or 4 that are going to be most relevant for your business, and there will be others too, but the 3 or 4 most relevant is there's one called Dext that helps you take pictures and scan if it's a bigger document, and store things directly into QBO, into your accounting program. Pluto is an automatic payment program. So think of the bank electronic fund transfers, but it's hooked into your actual list of payables. You can pay your contractors, you can pay your rent, you can pay your suppliers, all automatically through QBO with Pluto working behind the scenes. And payroll, you can do that. And like I say, the beauty of all of this is it's online. And so whether you're at the office or at home or on vacation and you have to get something done, you can do that. And it's just the way that things are moving. Another one that might be applicable depending on where you're working, if you're traveling to hospitals, things like that, and you have to keep track of mileage, there's a very easy cloud-based mileage tracking program called TripLog. And that can also tie into QBO, and we can set it up so that you can actually receive payments for your mileage out of your books and records. If you're not familiar with QBO, it also automatically links to your bank accounts and credit cards. There's no way to hack through to do anything, so there's no worry of that. but it allows the program to pull every day on a real-time basis all of the transactions that are occurring. And so the accuracy that occurs is much better than doing manual data entry into your books and records. We can also, as I mentioned earlier, set up auto payments for taxes and investments and personal draws, things like that. So if you've got a certain amount of cash flow and you want to transfer $10,000 a month to your investment advisor, that can automatically be set up in QBO and done that way. Bookkeeping, we call it data entry and data management. Those are sort of the two separate steps. It can be done quite more easily with it being cloud-based. We can provide the setup and training if you want to do it yourself. But what we have found most successful, because you guys are all very, very busy, is that we do the bookkeeping on a monthly basis for you as well. And that's easy to do, saves you a lot of time, and I think you'll find isn't very expensive as well. So that's as far as keeping it simple and trying to help you improve the running of your practice. Now I'll get into some of the more important practical things. One of the first questions everybody asks is, well, how do I get money out of my business? Especially if it's a professional corp, right? Because it's a separate entity and you've got your own bank account for it. So there's really 2 or 3 ways to get money out of the practice. I'll skip to the second bullet point there. Number 1, if you've put money into buying equipment personally that the company owes you for now, or that kind of a thing, that's considered a shareholder loan. And the company can just pay you back for that as a loan. It's not taxable. It's just, you know, an IOU that they're paying back. So that's one of the first ways that you take money out of your business. But once you've exhausted that and the company doesn't owe you any more money, then there's really 2 ways of getting it out that's taxed, and that's salaries versus dividends. And there's a lot of pros and cons to each, and I'll run through the main points of those. So first off, from a ease of use perspective, salaries require payments and calculations every month. If you have employees who are already dealing with that, you know that you've got to sit down, you've got to figure out your deductions every month. You've got to make your remittance to the government before the 15th. And you've got to, you know, factor those into payments and cash flow and that sort of thing. Dividends, on the other hand, are simply draws that can be taken out during the year. And then as long as they're characterized as dividends by the end of the year or when we do your year end, that's all that's needed. So they're a lot simpler from that perspective. You also don't have the cash flow requirements of making remittances. So that's the difference between those two. Just to clarify, salaries are a deduction to the company, and then therefore the company doesn't pay tax on any of that because the company's only paying tax on the net income. So if you had $100,000 of income one month and salaries of 50, you're only paying tax on 50. However, if you're doing dividends, the company's paying the tax on the entire 100,000 in that example. And then after the company's tax, I mean, it doesn't physically happen at that time, but you know, the money that won't need to be paid to the government that'll be left, that's what can be paid out as dividends. So that's the distinction there. They're close to the same rate when you look at the net end result. If you pull all the money out as salary or you pull all the money out as dividends, it's going to be fairly close. It's within 1.5%. But there's two main distinctions. Number 1, if you're not pulling it all out at once and you have the company pay the tax first, there's a big deferral opportunity, and that can be quite significant over a number of years. And number 2 is that there is a CPP component to salaries, not EI, because as the owner, you don't have to deduct EI. But there is CPP regardless of if you're an owner or not. And there's rules around CPP that a lot of people aren't aware of in terms of the benefit at the end of the day that you get, how it's calculated, and the overall cost. So at the moment in 2022, If you max out on your salaries in terms of like the CPP limits, it's $7,000 of cost each year. Half is paid by the employer and half is paid by the employee. So pretty significant amount. It has crept up a lot over the last 10 or 15 years for sure. The government calculates your ending CPP benefit when you retire based on a 47-year window. So age 18 to age 65. But they drop the lowest 15% of those years. And so if you've contributed or expect to contribute a lot over those 47 years, you potentially are overpaying anyway because you've already hit your maximum and it's not going to make much of a difference. The other thing to consider is that the return that you're getting on that 7,000 may not be near as much as what you could achieve on your own investing it yourself. Plus, then you have it under your own control. So that can be a big deciding factor in terms of whether you want to do salaries or dividends, because salaries do require CPP. There's no question, you can't get out of it. Dividends do not require CPP, and go from there. The other thing about salaries is that if RRSPs are important to you, salaries create RRSP room, whereas dividends do not create RRSP room. And so that sometimes is factored in. I think us at the firm here aren't big proponents of RRSPs. We see that there are some negatives about them. They're promoted quite a bit in the banking and investment community, but as far as someone who can set their own salary, they're really not all that great. And we can at another time dig into that, or if you have questions about that and we have time at the end, I can dig into that a little bit more. Because what you can do at the end of the day is you can keep that money in the PC, in your company, and invest it there and achieve good, better results than likely what you can in the RRSP. We've done the analysis a couple of different ways, and it often turns out, or almost always turns out better that way. So, on the topic of shareholder loans, I've already kind of touched on that, but there are a couple of other exceptions with shareholder loans. Besides just repaying you for what you've contributed, you can receive a loan, and actually I should clarify, it's not actually a shareholder loan at that point, it's an employee loan. So you can receive employee loans for homes and cars. Now, it's a bit of a funny area. We need to make sure we structure it properly and that it's described and papered well. But if you do need to pull money out to buy a car or to buy a home, it's possible to treat that as an employee loan and get money out that way without it being taxed as salaries or dividends. And then, one of the big reasons that we get involved in tax planning is to smooth out income. Which means that if you have a good year and you have $150,000 income that year, and the next year not so good and you only take out $80,000, we don't want to have you taxed at 150 one year and 80 the next. It's much better to be taxed at 110, 115 for each of the 2 years. You use up your tax rates better that way. So sometimes we will create shareholder loan because you've got a year where you didn't pull much money out, and you only need a $40,000 salary to cover off, or $40,000 dividend to cover off what you took out. But we'll still do an $80,000 or $100,000 dividend to utilize your lowest rates of tax. And that might create a $50,000 or $60,000 shareholder loan, which could then be used to offset a future year where you have good cash flow and you want to take extra money out. We can also do that kind of planning if, for example, you have a really big purchase or expense lined up. Maybe you want to do a large home improvement, a couple $100,000. So maybe for 2 or 3 years, we will record extra dividends so that you can build up a shareholder loan so that you can then use it for that instead of having to take $200,000 out in 1 year at super high tax rates. So that's a bunch of the planning that we will sometimes do and should be considered. A couple of other things I would just like to mention, just so you don't run afoul of them. So I don't know, 4 or 5 years ago, the Liberal government in their first term introduced what's called tax on split income, or TOSI rules. Some of you may have heard of them, some of you might not have. What TOSI rules are is that if a dividend is paid out to a family member, so spouse or a child, that's related to the owner, and they do not work significantly in the company. And by significantly, they've kind of measured that at 20 hours a week or more, either now or in the past few years. If they've never done that, then any dividends paid to them are considered to be paid at the highest tax rate. And that's the tax on split income, or TOSI rules. So they've basically taken out the ability to use dividends to split income with other family members, which used to be there, but has not been available for the last 4 or 5 years. And the last thing I wanted to talk about was when you're taking money out from your practice, and you've got, so we can't use dividends. We're getting dividends to the primary physician, but there's a spouse and maybe 2 or 3 kids. Salaries can be a very good vehicle for doing that, because you can pay out salaries. However, you do need to be aware of the need to be have reasonableness of salaries. And so typically what we have found is that depending on it depends on the scope or the size of the practice. If it's large, $500,000 of revenue or more, then paying a salary of $50,000-$60,000 is not unreasonable, regardless of sort of how extensive the work being done is, because it's a position of trust and authority and that kind of a thing. So if however there was only a couple $100,000, then paying a $100,000 salary to someone not working much in the business probably wouldn't be considered reasonable. So that needs to be factored in. You need to think about it. But generally, we have found that 50 to 60,000 is really no problem, and that's actually a very good level to have a spouse at in terms of splitting income. And then we've also involved kids. Children, they can come, they can clean up the premises, they can help with IT, they can get you on social media, lots of little things that they can do to justify a small salary of $5,000 to $6,000 a year, which can save $2,000 to $3,000 a year per child if you're doing that. So still some good opportunities there. And I've never honestly had a instance where CRA has come in and done anything to or like audited that and reversed any of those salaries. In 25 years, the reasonableness has never really been challenged in any of those circumstances. And that's about it. Any questions about any of the financial stuff?
There are 2 questions from Cassie in the chat, one for Mark and one for you, David.
Okay. Mark, you can go first if you'd like.
Yeah, sure. I read the question already. So the question related to information sharing agreements between physicians. Just going back to my comments on information manager agreements, that's required under the Act, and those are situations where you are relying on other third parties, like tech companies, other third parties to help you manage your health information within your office. So electronic medical records providers, for example. So in those instances, you need to have specific provisions as outlined under the Act in those contracts. When you're sharing information with other physicians in the context of clinical care, the Health Information Act does not really try to disrupt that. It recognizes that as a physician or a healthcare provider, you are required to naturally share information about your patient to other treatment providers. So in that type of a situation, you don't really even need to have any type of an agreement. You actually don't even need to have the consent of the patients in place, because that's a natural flow of information that you'd be expected to proceed with in the course of your practice. If you are working on other projects, though, with physicians or other third parties, then where you are sharing information and it isn't expressly contemplated under the Act, then that is a situation where you might want to have an information sharing agreements. The HIA does not specify exactly what you would need in terms of an information sharing agreements. But in that type of a situation, you would be really looking at mitigating your risks, ensuring that all parties are adhering to the applicable privacy legislation that they are bound by, and making sure that at the end of the day, you are fulfilling your regulatory and professional obligations in handling that information.
Great. Thanks, Mark. So Cassie, you had a question about parental leave. Can you maybe clarify what angle you're coming at from that? I'm guessing it might have to do with if you're getting like government or other benefits and the loss of those benefits perhaps, but could you clarify?
Sure, thanks. So I was just wondering because I thought I heard that you can't pay yourself a salary if you're on parental leave, if you're not actually working. So does that mean you have to structure your, pulling money in a dividend instead?
No, well, not from the perspective of like you can't, and that's why I was wanting to kind of clarify from what angle you're looking at it at. So, I mean, so assuming this is coming from a PC, right? Like your PC is still operational, it's still fine to pay you a salary from that. However, if you're talking about like you're getting a supplement from somewhere for being on parental leave, they may have rules that say if you have any salary, then you lose your parental leave benefits, right? Or they're reduced or that kind of thing. In which case, yes, then you wouldn't want to do a salary, but you could still do a dividend from your PC. So that's what I mean. It kind of depends where angle you're coming from with the question.
Yeah, David, I'm assuming Cassie's talking about the EI maternity program, in which case you would be limited to what you could pay in salaries. And certainly you can pay yourself dividends without jeopardizing the federal EI program.
Yeah. Is that kind of help address it, Cassie, what you were thinking of?
Yeah, that's good. Thanks. I think that most physicians don't end up using EI, and it ends up being, we have a provincial program through the AMA that pays.
Oh, okay.
For 17 weeks. So that's usually the way it goes. So
okay. So yeah, so if they follow a lot of the same rules, then yes, that you'd want to go dividends instead of salary. But you could check the more specific details of the rules to make sure. So Indira asked, can you buy a car under the PC? You definitely can. The question becomes, is it the most beneficial way to do it? Ironically, I bet you Darren would say too, we have that's probably the question we get the most often is, I'm buying a car, where should I own it? And the answer is it depends. It depends a lot on how much you're driving, what the cost of the vehicle is, because if it's a very expensive vehicle, it can be quite punitive to own it in the company because there's something called a standby charge that we have to calculate. So there's no easy answer to whether it's better to buy it in the company or not, but you can buy it in the PC. Just know that. So I would say ask your accountant and give him or her the details of what you plan on doing with the car, the driving, and how much, that kind of thing, and then they can help figure out the best thing, or we can help figure out the best thing. And then Geneva, when looking to have a partner join the practice and is an accountant, for business. So there are different resources you can use for getting sort of a valuation done. We do what's called a draft basic valuation. And that helps people sort of generally understand the value of their business and whether it's growing, whether, what it's driven on, how it's improving. However, in sort of either litigation circumstances or marital breakups, or perhaps on a specific buy-sell, if you want to go to something bigger or more involved than what we do, then I would say that a business valuator would be another good option, and they will do what's called like a full valuation, specific for your industry, specific for even your geographic area, things like that. We don't get into that level of detail, and so that would be the difference. But then there's also a pretty big difference in price as well. You're talking $2,500 for the one we do versus 10 to 15,000 or more for the ones that a full valuator would do. So that's, but those are the options that basically you have available to yourself for that. All right, any other questions? If not, it's bang on 1 o'clock. So our time management was pretty good. I would like to thank Britt and Mark for their involvement today. One quick question from Cassie. Mark, are you able to read that?
You know, Cassie,
Sorry,
I don't
it's sorry, it's long. I just copy and pasted that, but I think that the question I was having was regarding, was it an HIA requirement to have an ISA, or was it under the, so that looks like the college, like we have a requirement for that. I just didn't know if it was under.
Yeah,
the
I would need to look at the specific requirement from the college and the context that it might apply in. But under the HIA, I mean, the HIA doesn't even really speak to information sharing agreements. So rather, it simply facilitates the exchange of information when you're providing patients with clinical care. So it wouldn't be found under the HIA. I'll probably have to take a closer look at what the college is indicating that specific instance. And so if you want to, if you want to send me an email or chat more about that afterwards, then I can certainly do that with you as well.
Great. All right, so our contact information is on the screen there. Do feel free to give us a call or send us an email if you would like further information. We're here, we're around. We work with a lot, all three of us work with a lot of different physicians, physician groups. So thanks everyone for attending, and we'll keep you in mind if there's anything else in the future that we might think you might be interested in.